Hello, everyone, and welcome back to the Data Minute. My name is Peter. I'm the head of insights at Carta. And for this Q&A episode, we're going to dig into a whole host of questions, all from pre-seed founders. And this is ideal timing. We just released our pre-seed report. Actually, it's called State of Pre-Seed for Q1 2024. You can find that on Carta.com. So without further ado, let's get into the questions. First question from these pre-seed founders. How is pre-seed funding faring in this venture capital downturn? Well, if you look at this chart right here, the bar chart that we're showing shows the number of safe notes and the total invested capital for pre-price round investments on Carta quarter over quarter. And you can see that things peaked just like they did in late stage rounds in mid to late 2021. There's about $1.4 billion invested actually in Q2 2022. And since then, yes, funding even for this pre-seed cohort has been lower, but it's not that much lower. It's about $1 billion a quarter, which is very healthy, a quite robust figure when compared to the downturn that happened in B, C, and D rounds. So pre-seed is holding up better than basically every other part of venture. Okay, that was question number one. Question number two, what sorts of instruments are founders fundraising on in pre-seed? Well, it turns out that the SAFE, the Simple Agreement for Future Equity, has become the dominant vehicle to get early stage capital to these pre-seed founders. If you look at the chart that we're showing on the screen, you'll see one line going upwards, that's the black line, that's total invested capital on SAFEs, and the other headed down and to the right, that's total invested capital for these companies on convertible notes. It used to be in the beginning of 2020 or so that these were essentially equal, and since then, SAFEs have come to dominate the space. It's about 88% of all capital that goes into pre-seed companies are happening through SAFEs. So if you're not familiar with them, it's time to get familiar with this instrument. You can do that on carta.com/SAFEs. That was question number two, which leads directly into question number three. What kind of SAFE should I use? Well, if you're a pre-seed founder, it used to be the case that the pre-money SAFE was the default instrument. But in recent years, that's actually flipped over to the post-money SAFE, probably because Y Combinator, YC, changed the default template on their website, and most of Silicon Valley followed along with YC. So the post-money SAFE, as you can see in this chart here, takes in about 80 to 85% of the capital that's invested in SAFEs for pre-price rounds every quarter. It used to be about 50-50. Now it's close to 90-10 for that post-money SAFE. Yeah, and for those of you following along in just your eardrums and you can't see this chart, we're showing a bar chart with each quarter outlined, and the ratio in that bar chart is pre-money versus post-money SAFE. So out of 100% stacked bar, what percent went to each type of instrument? A couple notes about the post-money SAFE. It is a clearer instrument, meaning when you sign a post-money SAFE, you know exactly how much of your company you've sold to that investor when the next round happens. But it does come with a little bit of an investor preference in that it's anti-dilution built into the document. By this, I mean that if you raise multiple SAFE rounds with a post-money SAFE, you're essentially guaranteeing that slice of pie for each of those investors. So just be careful when you're raising on 2 or 3 or 4 different valuation caps, because that can tend to mess things up a little bit. All right, so that's the difference between pre and post-money SAFEs. Now let's get into the next question, which is, what are the key terms of a SAFE that I need to understand? It turns out there's not very many key terms when it comes to a SAFE. The two most important are valuation caps and discounts. Now, if you look at the chart on the screen, for those of you following along at home, you can see that this is again a stacked bar chart showing valuation caps and discounts, discounts only, and uncapped SAFEs. So 4 different kinds of terms that come along with the SAFEs. You can see that in the most recent quarter for Q1 2024, about, call it 90% of post-money SAFEs had some sort of valuation cap, either a valuation cap by itself, which was about 70%, or a valuation cap and discount, which made up another 30% or so. So that is by far the default term when you're coming into a SAFE. You're going to discuss with your investors what's the valuation cap on this SAFE. Discounts, a little less common, but still showing up very frequently. Discount-only SAFEs, pretty rare. And if you're able to get an uncapped SAFE without a discount or a valuation cap, you should thank that investor because it's probably your mom or dad. All right, final question. The one I get more than any other question in this set. What valuation cap should I choose for my business? This is a really nuanced question, and I can understand why pre-seed founders are so interested in it, because a valuation cap is very similar to a valuation, and there's so much discussion across startups about what valuation you should apply to your business. What I'll say is that valuation caps should function a little bit differently than the inherent value of the company that you're building. This is really a mechanism to bring together supply and demand at a price point that makes sense. So if you look at the chart that we're showing on the screen, you'll see 3 line charts for each of these sections. And that just shows over time the median valuation cap for a given round size when it comes to pre-seed raising. So if you just focus in the middle of that chart, you see that the rounds that raise $500K to $1 million, the median valuation cap on Carta today is $10 million. So if you raise $1 million on a 10 million cap, that means you've sold about 10% or exactly 10% of your business. Again, as an entrepreneur, I know it's tempting to get wrapped up in the valuation cap because it feels like you're valuing your company and in some ways yourself. But to be clear, the thing that you should really focus on is the dilution implied by that valuation cap. Take the amount that you're raising, divide it by the valuation cap, and that's the percentage of the business that you've sold, which is really the thing that you should be concerned at this early stage. And that's it. Everything you need to know about the state of pre-seed fundraising. If you want to learn more about what's happening in pre-seed fundraising right now, head over to Carta.com and click on the State of Pre-Seed Q1 2024. When you click on that report, you're going to get a whole lot more detail. What's going on in safes, what's going on in convertible notes, how safe rounds compare to price seed rounds. There's a ton of information in there. You can find that in our blog. You can also find a link below to Carta Launch, which is every single one of our best cap table features 100% for free until you raise $1 million. If you enjoyed this information, be sure to like and subscribe to this podcast anywhere you get your podcasts, or you can head over to Carta.com and sign up for the Data Minute newsletter. Hope to see you next time.